Okay. Hello, everybody. Sorry for the late start. My name is Trevor Murphy. I am the CEO and President of Financial Estate Literacy. Can the panelists hear me okay?
Yes.
Yeah.
Okay. Um, in regards to you, let me just orientate everybody. You are attending week 2 of It's Your Money. Uh, this is week 2 of 8. We will be discussing some of the financial products most sold in the financial services industry and some of the things to watch out for. We'll also be learning a lot about how the financial services industry works in regards to financial advisors and how they're licensed and so forth. So let me real quick go to, okay, Pete, I want you to, we have our first sponsor today, and I would like you to take on introducing Faye and the Hemlock Society of San Diego to our participants.
Hi, Faye, and thank you for coming on. And I know this is your first time, and we've had some technical difficulties, so appreciate you kind of sticking with us. I've had the pleasure of reading about Faye for many years, and she's just literally an international expert in the movement to allow people, give them education with the right to die. And she's the founder of the Hemlock Society, located in San Diego, because I believe, Faye, you live in San Diego, right?
I do.
Okay. So when people hear Hemlock Society, they probably have conjure different things in their mind. But what I would like to do is introduce you to our audience and tell us a little bit, what is the mission of the Hemlock Society?
We believe that people will have a better death if they know all their choices, all their alternatives. And so that's what we try to do, is educate as wide a scope of people as we can about their choices at the end of life. We've been around for 34 years. I founded this as a small child, a long time ago. And we were part actually of the National Hemlock Society, but we started the Hemlock Society of San Diego in 1987 with the mission of spreading the word around Southern California, if possible, about choices at the end of life. And so we do that by having monthly meetings to which anybody is invited. They just have to look at our website to find out how to get on. Now we're on Zoom. They used to be live, and they will be live and Zoomed again. And those meetings try to educate people about documents they need, situations that they might have, organizations they can turn to, what the laws are, that kind of thing. And things change all the time. And so it's important to not just learn it once, but to sort of keep abreast of things.
Well, if somebody wants to be part of the Hemlock Society, should they just go to your website? Is that the best way to go about it?
It is. It's Hemlock Society San Diego. There it is. Hemlock Society San Diego.org. And it's always San Diego. There was a National Hemlock Society. There is not one anymore. I was the head of that at one time, and I started this when I was head of that anyway. So this is actually the only Hemlock Society there is left in the country, and we're known for helping people with information about self-deliverance, what laws are available, all those things that you're pointing to now that are on our website. And we believe in choice and dignity at the end of life, good death. And we think that people should be able, consistent with their own values and beliefs, die the way they would like to, again, consistent with the laws. So that's what we do. And we get feedback that this is helping people make decisions about their end of life, just as you helping people make decisions about the end of their lives financially.
Yeah. And I encourage people to, if they want to learn more about the mission and the organization, because it's just a fantastic amount of resources that she has. We're going to do medical care planning in the It's Your Money session. And one of the things that Faye has shared with me in the past is medical directives that include the right to die on your terms versus the institution's terms. And if you're at all interested in this, I encourage you to donate to the Hemlock Society, get involved, and become a participant.
We are a nonprofit and we exist almost totally on legacies and our membership dues and donations. Actually, in the 34 years we've been in existence, our primary source has been legacies, particularly free legacies from members. So members, non-members, sometimes we don't even know who's contributing, but people do appreciate knowing what they can do to make their end of life better and their loved ones too. So it's documents and information and general ideas about how to do this.
Faye, thank you so much for coming on and explaining a little bit of what the Hemlock Society is all about. And just for everybody's information, the hope is that in the next couple of months, we'll do a special program on the right to die and medical care planning. And so Faye, thanks again for coming on, and we look forward to seeing you again.
Thanks for what you do, Pete. I'm looking forward to this meeting.
Okay, take care. Bye-bye now.
Bye.
All right. Thank you, Faye. So just a reminder that we are only sponsored by charitable sponsors. And we have a wonderful presentation today. Pete, what can we expect from today?
Today's session is about the financial services industry, the way it is. It's about selling. It's about selling products. And annuities and mutual funds are some of the biggest products that are sold, but they're certainly not the only ones. Mortgage-backed securities, credit cards, options, commodities, limited partnerships in oil and gas and in real estate. It's all about selling a product and earning a commission. And there's nothing wrong with that, but it's not financial advice. So what we're going to go through today is we've got Paul Horn. Paul is a fee-only fiduciary advisor. So let's bring up Paul's Ask First form.
It's on his, he was good, Pete. He put it first page of his outline.
Okay.
And you can also get it separate from the outline on the materials page.
All righty. So I hope everybody can see it. Paul, welcome to our Zoom meeting. And
Thanks for having me.
You've got a master's or other advanced degree. What's your degrees in?
Yeah, so my credentials would be a certified financial planner. I'm a certified private wealth advisor. And then my master's degree is in investment management from Creighton University.
Wow. Lots of good education. What does the CPWA mean?
CPWA is Certified Private Wealth Advisor. It's a designation CFP can choose after the CFP, which is focused on more advanced or complex estate and tax planning. Okay.
And what did you have to do in order to get that designation?
You have to meet certain requirements like holding your CFP, having a certain amount of time in the industry, and a certain education level of at least having a college degree.
Okay. So you can't just buy that designation.
Correct.
Okay. Because in the financial services industry, you can buy a lot of designations.
Yeah.
Okay. We've got the relevant licenses down. You're a fiduciary to your clients. If you scroll down just a little bit, how do you charge your clients?
So the way that we are paid is fee only. Typically, that's going to be a percentage of assets under management. So for managing investments for a client, we'll charge them a flat fee, and that's how we are paid. So it comes directly from the client. We do not receive any bonuses or any commissions on the sale of any investment products or insurance products.
Okay. And so if I were to bring, do you have, well, first, do you have a minimum?
Minimum is about 20,000.
And then, and what's your percentage? How's your skill?
So the percentage varies depending on the type of investment. For most clients, it's going to be somewhere between 0.75% to about 1%.
Okay. Do you offer a free initial evaluation, look-see meeting with you?
We always offer a complimentary analysis. We want to do an initial meeting. We want to make sure that we're a good fit for you and that you're a good fit for us. And we'll provide general financial advice in that meeting. If there's any concerns or anything we see that might be able to help you, we're certainly trying to do that at no cost.
Okay.
Sorry, guys. We had just some comments that they asked first was hard to see in there. So I brought it up separately so they can see it better. Just go ahead and continue, Pete. Sorry.
It's still on, looks the same on my screen.
Yeah, you have a panelist view. I'm talking from the attendees.
Okay, great. Back to your fees. Do you work on any kind of an hourly basis?
So if we are going to be doing financial planning for clients, we can work on an hourly basis there.
And what do you charge on those hourly basis?
Depends on the complexity of the plan, typically around 200 to 250 an hour.
Okay. And when somebody is under your percentage fee basis on an annual basis, is there a limit to how many times they see you, talk to you, ask you questions? Give us a kind of a, what do they get for their money?
That's always an excellent question. You can talk to me in this smiling face as often as you want. We work in a team-based approach here. We actually have 25 employees. So typically when you have a meeting with us, you're going to have 2 advisors in the meeting. So that way, if one of us goes on vacation or something happens, there's always someone that you're comfortable with that knows your situation that can help you. We will meet most of our clients when we first start out. We'll have a lot of initial meetings, and then we'll meet about every week for the first like 4 to 6 weeks, just getting them on board. At that point, finishing and implementing the financial plan, helping them understand how to log in to view their accounts, how to read their statement, things like that. And then ongoing, we typically will do quarterly or semi-annual meetings with our clients, depending on their comfort level. We have some clients that want to meet monthly, and that's totally fine, and we meet monthly with them.
Okay. All righty. And let's see. And you're not affiliated with anyone that sells products, and you don't accept or give referral fees?
No, we don't give or accept any sort of referral fees. If we have a client that has a genuine need for an insurance product, we can provide a referral to a broker, but there's no connection with them in any way, and there's no monetary benefit we get other than sticking our neck out if they do a bad job.
Okay. Well, Paul, your background is interesting, and one of the reasons why I've asked you to present in this session is that we kind of half kiddingly actually, say that you were from the dark side.
I was.
Talk a little bit about that, what that experience was, and who did you work for?
Yeah, absolutely. So I cut my teeth in the industry with Wells Fargo. That's where I started personally. Wells Fargo is a broker dealer. So with the broker dealer, your job is to sell product. You have goals that you need to meet. So a certain amount of mutual funds per month, a certain amount of annuities per month, whatever the case is. And you're measured on your performance to how well you do that. how much revenue you're bringing into the firm is ultimately how they measure that. And I spent a good chunk of my career there. I was there with Wells Fargo for a while. And then my last position was with JP Morgan in 2013. I joined them as part of their private client group. And while I was working with them, I was actually one of their fastest growing advisors. I was on a national sales call. So we're talking in front of thousands of advisors. Myself and a handful of other individuals got called out because we didn't sell any annuities. And we had an annuity goal. So our national sales director, the guy that oversaw all advisors in the country, called me out and asked me why I hadn't sold any annuities yet. It was at that product that was the last straw for me when I knew that they were focused on selling product, but when I'm getting called out, when I think I'm doing a good job for the client, trying to take that, a fiduciary type approach or really try to meet the client's needs, and I'm getting called out because I haven't sold something that isn't good for my clients, that was the last straw. And that's when I saw the light at the end of the tunnel, so to speak, and switched to become a fiduciary.
Speaking of JP Morgan, JP Morgan is one of the most highly respected broker dealer in the industry. Jamie Dion as the CEO and nationally known. I think he makes a little over $1 billion a year. And he has a net worth of over $1 billion as well. But, we had Bernie Madoff just recently died. Guess how much JP Morgan had to pay out to the U.S. government because of Bernie Madoff?
500 million to $1 billion?
No, 2.6 billion.
Wow.
That was their fine. Not only that, but they sold all of their holdings practically prior to informing the U.S. government that Bernie Madoff was stealing from their customers. What I'm trying to get at is that these institutions are broker dealers. It's kind of like when you go to Vegas, the owner of the casino doesn't care about what you bet on, just bet. It's the same thing in the financial industry.
Well, doesn't the rule apply that the house always wins as well?
Exactly. It's all about you buying stuff. Doesn't matter what, like you said, every single rep has a goal. X number of annuities, X number of mutual funds, and whoever the winner is, they offer incentives, a contest, a free trip. It's the broker dealer mentality. And until you figure out that that's not what you're in for, that you actually want financial advice, you need to go to a fiduciary financial advisor.
Yeah, I mean, I personally made the switch back in 2013, 2014. Since then, I've had about 100 individuals that I know in the industry that have also made the switch from being a broker dealer to being a fiduciary. During that same time frame, I do not know a single person that has gone from being a fiduciary to being a broker.
Okay, let's get into the program.
Okay, real quick, there's one question. Paul, there's a question about, I believe it's like a question of where you custody your client's money. It says, is your money with a company like Vanguard? Can you advise on that? So can you explain a little bit about where you keep your clients' accounts?
Yeah, absolutely. So personally, if we are managing the money for our client, we will keep the money with either Schwab or Fidelity. We keep it there with a third-party custodian to avoid those Bernie Madoff situations. If a client has like an account at Vanguard and they want guidance on it, but they don't want us to necessarily manage it, they want to make the investment decisions themselves, then we can do that by doing a financial plan for them, which would cover everything from retirement to taxes to estate planning, cover all the aspects of their financial lives. They could pay for that, or they could pay us on an hourly basis just to do some analysis and make some recommendations if they wanted to go that route as well, if they wanted to keep it with Vanguard.
Okay, thank you.
Let's go to the presentation.
Here we go. So looking at who oversees all these knuckleheads with the broker dealers, really it's going to come down to the Security and Exchange Commission, the SEC. They are the US government agency that's going to regulate all the transactions, try and oversee all the professionals. Really what they're trying to do at the end of the day is help prevent fraud, manipulation, and deception. The other industry association to know is called FINRA. That's the Financial Industry Regulatory Authority. There was called a self-regulatory organization. That's a mouthful, SRO for short. And their members they're kind of self-regulated, so they're not linked to any sort of government agency or anything like that. While they try and help, ultimately at the end of the day, the one that we really need to know is the SEC, because they are the government agency that oversees all the securities industry, including FINRA itself.
Okay, Paul, on your business card, do you have to include the little FINRA logo?
Honestly, I haven't used a business card in a really long time, so the answer is no.
No, exactly. Okay, so if you see FINRA on a business card, it means you're dealing with a broker, because it's a self-regulatory organization, an SRO. So Goldman Sachs, Merrill Lynch, JP Morgan, all regulate themselves. How much assets do you think JP Morgan has? You want to take a guess, Paul?
Let's say 4 trillion.
Yeah, 5 to 6 trillion, and their hope is by the end of the year to have 10 trillion. So these folks, Greenspan, when he was in office, he said that these folks didn't need to be regulated because they would take care of themselves, and that fraud is absolutely normal. So it gives you an idea of this mentality of the industry. Let's go to the next slide.
So when you're with a broker, you have to have licenses. So for example, when I started out in the industry with Wells Fargo, I ended up obtaining my Series 7, my Series 63, and my Series 65. Most brokers, those are the licenses that they're going to hold, because that's what's going to allow them to sell you virtually any product that's related to stocks or bonds. Now, the managers that oversee them have additional licenses. Those are going to be the 24 and the 53. Some individuals, and the ones I think you have to be most cautious of, are those that have their life insurance license and their Series 6, which isn't even listed here. Because if they have just their Series 6, all they can sell you is mutual funds and life insurance. That's it.
Okay, so licenses are not credentials.
Correct. In the broker world, you have to have these to be able to talk with the clients about those products.
It's kind of like a driver's license.
Essentially, but being on the fiduciary side of the world, we don't have to have all these licenses because we're not selling the commission-based products.
Exactly. So it's kind of it's kind of weird that because you don't sell any sell any products, you don't have to have any of these licenses. And sometimes people think, oh, you must not be as qualified.
Yeah,
it's the exact opposite.
Exactly what I was going to say.
Just to clarify, though, you do have to have a Series 65. Is that true?
That is correct.
Yeah.
Okay, yeah, because it's up here on the screen, so just making sure.
Yeah, I know. Yeah,
Okay,
this is the one.
Let's
This
go
is
ahead.
the one you do want to see, because it means that they're selling a managed type of account, which is what we do here, managing money for clients, not trying to sell you a commission-based product.
Okay, let's go to the next slide.
All right. Dinner and date with commissions. These are always fun. So Wall Street, we've seen the movies, whether it's Wolf on Wall Street, whether it's the one that was about 2008, I'm like on the name of one of my favorite movies of all time. Anyways, in these movies, you always see them eating in nice restaurants. Their primary way of finding new clients to sell commission-based products to is going to be wining and dining. When I started in the industry, I was actually given a budget that I could spend on a monthly basis to host these type of events where we're selling steak dinners. And the goal is at the end of the steak dinner, you sell a commission-based product, kind of in a high sales, an aggressive manner, typically, to pay for those steak dinners.
What is it? You got a red box out there. What does that mean?
The red box right here is exactly what you had pointed out earlier, Peter, talking about the business card. Again, because they're part of FINRA, they have these disclosures that they have to provide. If you see these, that means it's being done by a high pressure broker, most likely. Not all brokers are high pressure. I should be very clear on that. Just because some of the broker doesn't necessarily make them a bad advisor. But with the problems that we see come from the broker side more often than not.
Yeah. And here in California, if you're going to sell insurance, you have to put your license number on the marketing material. So you'll see that this program is going to offer insurance products and they have their license number.
Correct. Yeah, so it's that old adage, if it's too good to be true, it probably is. That certainly applies to these sort of things. I find these work best as kindling for fires or shredding in trash.
Just a quick question. What are typically sold at these dinner and date with commissions?
So these dinner and date with commissions, most often it's going to be either a wrap account or it's going to be an individual stock pitch or
Index
private
annuity.
equity deal. But most commonly, it's an insurance product.
Yeah, indexed annuities is going to be the big one.
Yeah, and I have a personal story of a client that went to one of these and got ripped off, and the great lengths we had to go to help her out.
Yeah, and they try to hide them to show that they're educational. So let's see. So this one I got in the mail just the other day. It's Rejuvenate Your Retirement, traditionally held at Soka University, Wednesdays and Mondays, and they're doing a Zoom like we do. And and they offer a course and you have to pay for it. And in it, let's see, they have instructors, and if you could see that they're both from Northwestern Mutual Investment Services. Northwestern is an insurance company, and I looked both of these people up, and they were insurance salesmen before. And then again, nothing wrong with it, but you're not getting an objective education here. This is product sales, but disguised as in an educational format.
Yeah, and the brokers that are doing these type of things, typically, if you think of the investment universe as like a pie, right? If you have a pie, you typically have about 8 slices in that pie. There's about 8 different things that could be done to help a client with their money. They're limited to typically 1 or 2 or maybe 3 of the slices of the pie. They can't sell you or help you with everything.
Let's go to the next slide, Paul.
Yep. So some things to look for if you're trying to find a good advisor. Just remember that not everyone that calls himself an advisor is created equal. The most important thing here, as we've already touched on, is you want to find someone that is a fiduciary. You want to make sure that they're acting in your best interest at all times. Most often for these brokers, they don't have to be a fiduciary. They have to just act in what's called the best interest. So it just has to be quote unquote suitable for the client. Really, it's going to be in the best interest of the broker more often than not best interest of the client. Ideally, you want to find someone that is fee only. This is just going to help reduce inherent conflicts of interest and align their interests with yours.
So what a lot of the people in the industry are doing is that they're putting on their card that they're fee-based. And fee-based literally means they could charge you fees and commissions.
Correct.
So you want to make sure that they only can charge you fee only, that the only monies that they receive is coming from you. So their only obligation is to you.
Yep. And then ideally, you want to find someone with proper education. The 3 credentials, you should be looking for someone that has one of these 3, which is either a CFP, someone that specializes in financial planning, a CPA, someone that specializes in taxes, or a CFA, someone that specializes in investments. These are the most widely recognized credentials, and certainly it doesn't guarantee that you're going to be getting great advice from these individuals, but it means that they've paid a lot of money and a lot of time to try and help better educate themselves.
The assets to be held in a third-party custodian we talked about.
Yeah. And then there's some general questions you want to ask, like what kind of services do they offer? Do they work with similar clients with you? You know, more and more advisors these days have niches. So some might be really good working with retirees. Others might be really good at working with doctors that are, you know, building a brand new practice. So you want to make sure the advisor you're working with works with clients that are similar to your current situation. And finally, what services are they offering and how often are they willing to meet with you?
I think that besides the ask first form, one of the most important things is that you look up the individual on broker check. Trevor, are you going to pull up that how to look up a person, or is Paul? Trevor.
Yes, I'm here. Sorry. I can do that.
Okay.
Yeah. So Paul,
okay.
stop
Let
sharing
me give a little background here. I'm not going to use her last name, but Mary called me last week and said that her mom was dying and she wanted to have some questions answered regarding her trust. And so we got around to, who is your financial advisor? And she goes, well, the financial advisor that we have has been a trusted individual. He's been with the family for the past 20 years. Just a wonderful individual. And I said, well, have you looked him up on broker check? And she said, no. So she gave me the name, looked them up on broker check. And so what do you do when you look somebody up, Trev?
Well, you can put the name here in the hang on, I'm going to get what Paul's got a cool annotation thing so I can be as cool as him. Okay, so you can put the name, if you know the name of the individual, you can put it in this box. And
which
you did. And then you can search. You don't want to put the name in. I mean, this is public knowledge.
Yeah, it's all public information.
So do you want to look him up? I don't know his name.
You can put my name in if you want.
No, I want to put his name in there. Troy. I gave you the name, Trev. I don't have it in front of me. Okay, we don't have to do it. Okay. Anyway, you put the name in there and then you just click on search. And then once it comes up, it'll tell you a little bit of a background on the individual. And this particular individual, and remember his first name being Troy, I can't remember his last name, but had 5 disclosures. Paul, what does a disclosure mean?
Disclosure means that they messed up or did something they shouldn't have done. Typically, it's going to be some form of client complaint that is found to have merit. So making a bad recommendation, selling them something that they shouldn't have sold them, something like that most often.
Yeah, and to get a disclosure is not easy. I mean, you've got to go through some real hoops in order to get a disclosure. This particular individual had 5 of them, and then so each person who works in the industry is also working for a broker dealer. So it's a Merrill Lynch, Wells Fargo Advisors, UBS. Well, this particular individual worked for LPL. So I did a little search on LPL.
I can put that in.
And it turns out that LPL is a broker dealer, and the press release is that they're notorious for hiring individuals who are high sales capability and have disclosures, and which is just unbelievable. They had been fined by FINRA like $7 to $20 million just in the last year. So it's incumbent upon each one of you, if you have a broker, check out the individual on Broker Check. It's very easy to do, and use that ask first form. You want to stay away from these individuals. It's your money. Alrighty, let's continue.
Okay. Okay. I'm going to stop sharing. There you go. Paul, go ahead and bring yours back up.
Yep.
So we're going to get now into the annuities and just one of the products. What is an annuity, Paul?
So an annuity in its simplest form is simply an insurance contract where you, the individual, exchange a lump sum of money to the insurance company, and what you get back is going to be a guaranteed income for typically your life, or if you're married, maybe you and your spouse's life, or it could be for a certain number of years. Annuity in its most basic forms, that's what they were designed to be and what they really are.
And how long have annuities been around?
100 years, 100 plus
Yeah,
years.
a long time.
Yeah, I mean, if you look at the whole concept of annuity actually goes back to the Roman times.
Yeah. But what does it mean that annuities are not subject to SEC rules?
So we've been talking about how the SEC oversees and they provide oversight on the investment industry. However, on an annuity, it's an insurance product. It's subject to the rules from the insurance. And the insurance side, those are actually ran at the state level.
There is no national insurance regulatory body. The
Correct.
Insurance industry has got to be the most powerful industry in the United States.
And it's scary because I can show you several examples of individuals that have been barred from the investment industry by the SEC, but they're now just moved into the insurance only industry.
Yeah. And there's no surprise that most of your states that are incorporated for insurance companies are states like North Dakota, Montana, Delaware, and the like. There is no national insurance regulatory body. So if you were to sell annuities, do you have to be licensed by FINRA?
Nope, you just need to pass your state's insurance exam.
Okay. So what does that mean? Earnings in the annuity grow tax deferred.
Yeah, so the annuity itself, when you put money in, typically, like if you have a taxable investment account, as you sell the investment, you pay taxes at that time. With an annuity, say on a taxable account, money that would normally be taxable instead grows tax deferred. You don't pay taxes while the money's growing or each year. You're actually going to pay taxes on the distributions. When you start taking the money out of the annuity, that's when you're going to pay the taxes on that. And that's actually kind of could be a bad thing because you may be paying higher tax rates because of this. if it's a tax deferred account. So if the money's coming from like from a bank account or something like that. If it's coming from like an IRA, it's going to be very similar rules as an IRA. So there's not as much tax implications there.
Yeah, there's no reason why someone should have an annuity inside of an IRA.
100% agree. Unfortunately, those are the most common forms of annuities that I see clients having.
Not all annuities are bad. Annuities can be good because they do create some income.
Correct. Yeah. And ideally, you want to find, annuities can be a great source of income, kind of like a self pension, if you will. But just you want to you want to go through a fee only advisor, and typically you want to avoid what are called surrender charges, which we'll talk more about in a little bit.
Can if you own an annuity and you want to change to another annuity, is that feasible to do?
It is. So if you have an annuity, there are a couple options that you can look at. You can look at just taking the money out and closing the annuity altogether. As we talked about here, that may trigger some taxes. So you're certainly going to want to talk with a fee-only advisor or CPA about that before doing that. You can also do what's called a 1035, where if for tax reasons, whatever the case is, you could look at taking the annuity that you currently have and moving it into a better annuity and not taking on those the tax implications.
Yeah. And when we say a better annuity, we're talking about an annuity with lower fees, maybe a higher payout, etc.
Yeah.
Let's go to the next slide.
Yeah. So when we look at annuities, there's two common types. There is what's called an immediate annuity. This is the traditional annuity that we talked about. You give your money to the insurance company. Next month, they're going to start sending you a check for the rest of your life. Okay. Those are the simplest and most purest forms of an annuity. Unfortunately, most people have what's called a deferred annuity. That's where you can either put in a lump sum or money over time into an annuity. It's going to grow in some form or fashion, and then you turn on that income stream later on in life.
What I find is that a lot of teachers and professors at universities have deferred annuities. And if you are a teacher or or worked in a university setting, on the materials page, there's some really good articles that the New York Times put together on deferred annuities for the education profession.
Yeah, it's really sad to see the predatory nature for teachers and that they have to deal with.
I have a question. Someone asked, why would someone pay after-tax dollars to buy an annuity just to be taxed on the money later? Wouldn't a Roth IRA be a better option?
From a tax perspective, absolutely, the Roth IRA is the better option. It's going to have tax-free distributions, and the money is going to have better growth potential because it's not going to have the same fees or higher fees that you're going to have to be paying with an annuity. So if your focus is on growth of that money, a Roth IRA is a better option. Where you might look at the annuity would be for income planning purposes.
And remember, most annuities are sold. They're not bought.
Correct. Yeah, if there's ever a client that I help with that has a need for annuity, it's the last thing that we kind of back into when nothing else works.
Let's go to the next slide.
Sure. So looking at those deferred annuities, there's three separate types. There's what's called a fixed annuity. It works very similar to a CD. Your money's put into the annuity and you get a guaranteed rate of return. So there's no fluctuation. These are best in a high interest rate environment because the higher the interest rate, the higher the return is going to be on the fixed annuity.
If you have an older annuity, do not get rid of it. This is the no change workshop. Don't make any changes until you fully understand what you have. Today, if you have an annuity that many of them are 4% payouts, where can you get a 4% fixed rate payout, almost nowhere. So
Yeah.
don't, just because you have an annuity and you're thinking, oh, I shouldn't have one, and get rid of it. Please don't. It might be something really worthwhile saving.
Yeah, older contracts can be 3% or higher. The new ones are typically under 1%.
Yes.
Completely agree. The other one is called a variable annuity, is the next type of deferred annuity. The variable annuity is just as the name sounds. It's because your returns or the money, the growth in the account is variable. With these type of annuities, what happens is your money is actually going to be invested in mutual funds. So it's going to have a mixture of stocks and or bonds. And then you will have growth in that account based on the performance of those mutual funds. So if the mutual funds go up 10%, your money can grow 10%. If the money goes down 20%, you could lose 20% in the variable annuity.
25 years ago, Paul, you're much too young to know this, but on the front cover of Forbes magazine, Forbes called variable annuities legally stealing because they were so embedded with fees. And when people got them, they had to have prospectuses and they had to have an annuity contract all in one. So it looked like an encyclopedia when you had to sign the contract. Nobody understood what was in that contract.
Oh yeah, I mean, those contracts could be as thick as a phone book.
Yeah. And this is the newest, is the indexed annuity.
Yes. The index annuity, the idea behind it sounds good, which is you put your money in, the money is going to, your rate of return is linked to an index, most common the S&P 500. And with these ones, you have a cap on which you can make on the upside. So maybe you're limited to making 3, 4, 5%. But if the markets go down, your return is 0 and you don't have that potential negative loss like a variable contract. On the face of it, an index annuity sounds very attractive, but when you dig down into it, you realize that it's really a very, very complex product. In fact, hardly any advisor truly understands what they're selling when they sell these index annuities. And they often come with the highest commissions, could be as high as about 15%. And they typically have the longest surrender charges of about 15 years.
Stay away.
So let's talk a little bit more about that surrender period and how that works. The surrender period is a period of time that you're going to have the annuity without paying a contract if you want to take your money out of the annuity. Okay. The shortest or most common one that I see these days is a 7-year contract. So this is an actual example from a client that bought an annuity recently before they joined my firm. But you can see it's 7 years here, and the penalty goes down over time. Starts at 8% for year 1 and year 2, goes down to year 3. So to walk you through an example here, let's say the client year 2 decides that this is a bad investment. They want to get their money out. Well, to do so, they have to pay an 8% penalty. So if they have $100,000 in that annuity, their penalty is going to be that 8% times 100,000 or $8,000 that they're going to have to pay. So they would only get 92,000 back out of their $100,000 investment.
Yeah, and the surrender charges become effective 30 days after you sign the contract. And the reason for the 30 days is that annuity contracts are so complex that most people cannot understand it. In fact, Worth magazine said there was about 12 attorneys who do not work for an insurance company that understand an annuity contract. They're so difficult to understand. So that after the 30 days, if you decide to get out of it, that surrender charge kicks in. And that pays for the sales commission to the person who sold you the annuity. Okay? Because if you stay in the annuity, then the fees and internal fees of the annuity that you're paying, which you don't see really, go to pay the insurance company back for making those guarantees, making that income, etc.
We had a quick question.
Yeah.
So when you have a annuity and you have a bunch of mutual funds and investment choices inside the annuity, who is managing those investments?
Typically, it's the individual that's buying the annuity. When you initially buy the contract, the advisor that, or the broker, whoever's selling it to you, they may provide recommendations initially, but they're going to be moving on and they're not going to be providing ongoing recommendations. So unless you hire some sort of professional to actually manage it for you, it's going to be the individual client.
And those mutual funds, the only thing the same is usually the investment advisor. All the other things as far as 12B1 fees, other expenses, commissions, etc., are all different.
Yeah, we'll get into that for sure.
Yeah. Next slide.
All right, so variable annuities are highly complex. Most people don't understand what they're even paying for. So I wanted to give a sample here of another client's annuity contract that I saw recently. As I said before, these variable annuities, while they give you great growth potential because the money is invested in mutual funds, it's going to come for a much higher price. The cost of the insurance contract itself is known as mortality and expense ratio. That typically is around 1.25%. On top of that, they're going to have an administration fee of another 0.25%. And as we said, these are invested in mutual funds. Each of those underlying mutual funds have their own fees. That typically is around 1%. And then most often with these variable annuities, they're going to sell it to you because it's going to give you this great income benefit down the road. And to get that additional guarantees that they're promising you, you have to pay an additional fee for what's called a living benefit rider of another 1%. So it's quite common on these variable annuities for a client to be paying 3.5% or more a year in fees. And this is an annual fee. This is not a one-time fee.
And this is addition to the surrender charge.
Correct. Yeah, this is the minimum fees that you're paying.
Yes. Let's go to the next slide.
Yeah. All right. So this is an actual index annuity for a client that I just did a financial plan for 2 weeks ago. They bought this index annuity, again, not understanding what they had here. And this is their statement from the end of last year. Now, their index that they're using for this is the S&P 500. Last year, the S&P by end of the year made over 15%. Now, because this annuity is so complex and so many gimmicks in it, the client's return last year was 0%, even though the index it's linked to returned 15%. This is why Peter and I are not fans of index annuities.
And they sell them though with the concept that you will get the gains and we'll take the losses. But the thing of it is that as Paul just kind of demonstrated, you need a PhD in math to try to figure out how they calculate your return.
Yeah, what they're doing here is they're capping you at 1% per month on the upside, but unlimited losses on the downside. Seems pretty fair, right? All right, so let's go ahead and move on to mutual funds.
Real quick, I don't know if you'll get to this later. Someone asked a question about a living benefit rider. Is it for a spouse?
So a living benefit rider, what those are is it takes a complex annuity and makes it more complex. Okay, so at your most basic level, think of a variable annuity as a 2-lane highway. Okay, you're going to have your lane, which is going to be the slow lane, which is what's called the cash value. That's your money that you put into it. That's the money that's going to grow based on the performance of the mutual funds. That's the money that the fees are taken off. If you want to add a second lane to this and make it and have a faster lane, or essentially what I call a toll road, they charge you this living benefit rider. And what that says is instead of your income being based on the growth of your cash value, they're going to give you guarantees like your money is going to grow at 7% per year or 10% per year simple interest or some sort of guarantee like that. And so that's going to be a different lane. And then your income that you receive in retirement can be based off of that toll road that you're paying for. So when these annuities pay out, they'll pay out like say 4.5% per year of whatever your contract value is. So if the contract's 100,000, you're going to get 4,500 a year in income. Or if you have that toll road, it might bump that up a little bit more. But again, you're paying for that additional benefit.
Okay, real quick, just let you guys know, we got about 30 minutes left.
Okay, just a couple of items before we leave the annuity area. Charitable gift annuities are completely different than commercial annuities. Okay, a commercial annuity could be anywhere from 10 to 30 pages long and nobody understands it. A charitable gift annuity, on the other hand, is 2 pages long. Any 90-year-old can understand it, and it's part gift. Nobody earns a commission on them, and they're absolutely something to consider if you're considering a fixed income kind of an instrument, and the benefit goes to a charity upon your death. That's one. Second is, for most of us, Nancy Reagan said to drugs, just say no. For most of us, if somebody pitches an annuity, just say no. There's no reason for most of us to have an annuity. And if you do need an annuity, see a fee-only advisor. There's so much commissions in these that it's a sales tool. It's one of, for the regular retail broker, annuities brings in to them the most money. That's why when Paul first started out, he said he was required by the broker dealer to sell X number of annuities. You don't want to be part of that. Let's go to mutual funds.
All right, mutual funds. So let's talk about what they are real quick. Essentially, all you're doing is investors pool their money together. They're going to give the money to a fund manager who's going to choose the investments in that mutual fund. Those mutual funds are going to generate returns over time, and those returns go back to the investors. So you're pooling your money with others, it's being invested, and you participate in the growth of that money. When we look at the types of mutual funds, they're going to be stocks or bonds. Now, specifically, they could be US stocks. These are going to be companies like Coke, Apple, or Microsoft. They have an annual expense ratio, which is, again, the cost of running that mutual fund. That is typically going to be about 0.75 to about 1%.
And those monies are going to the investment advisor.
Well, this is part of it's going to the actual cost of just running the business too, for the mutual fund. You have the international stocks. So this is going to be investing in foreign countries, companies of foreign countries like Germany, Japan, or China. This could be companies like Sony or BMW, for example. Their annual fees are going to be a little bit higher, and they typically range about 1.25% to about 1.5%. And then we finally have bonds, which are going to be a more conservative investment than equities. And as a result, the fees are going to be lower. It's going to be about 0.5% per year. So about 0.5%. General rule is just remember stocks are going to be more aggressive and bonds are going to be more conservative.
Let's go to the next slide.
Okay. So when it comes to how you buy the mutual fund is very important. Okay. If you buy it from a broker or one of those licensed insurance agents, it's going to carry a huge commission. Okay. If you buy it from a broker, they're going to sell you most likely a Class A share. So this Class A share is going to have a front end fee of 5.75% on average. Could be higher, could be lower. This is the commission that goes directly to the broker. So for example, if you invest $100,000 into an A share, you're going to pay that upfront commission of $5,750. And so what you invest in the mutual fund to start is actually going to be 94,250 instead of the 100,000 because of the
Okay.
commission.
If Paul, if
Yep.
I were to give you $100,000 and your fee you said was around 1%, so
Correct.
that would be $1,000, right?
Correct. And that would be paid at the end of throughout the year. So you would, if you invested 100,000 with us, you start with all $100,000 being invested.
Exactly. And if you after the first quarter say, Paul, I don't like you, maybe then I've spent maybe $250 with you.
Sure.
And what happens if after the first quarter I don't like the broker that I'm dealing with?
Well, you can take your money, but that commission has still been paid. So
You
you're
lose
only
it.
going to take that 94,000 and some change.
Yeah. And most people think that fee-only advisors are more expensive than brokers. And it's the opposite.
Correct.
What is the Class B and Class C?
Class B, if you hear from that, run for the hills. It is the highest form of fees. Anyone that recommends this to you, I would just turn the other way and run as fast as I can.
So, but if you see your statements and you're with a broker, each one of your mutual funds will say on your statement, whether it's a Class A, whether it's a Class B or a Class C.
Correct. And the final one is the Class C. This one has no initial fee, unlike Class A, but what it does instead is it charges you an annual fee instead. So while that sounds good in practice, because you're not paying that 5.75 up front. So with the Class C, if you invest 100,000, all 100,000 is being invested day one. But the downside is you're going to be paying that annual 2% fee. So for $100,000, every year you're paying $2,000. So over 10 years, you could be paying $20,000 in commissions versus $5,750 in commissions over a 10-year period.
So in your practice, Paul, do you use any load funds in your in portfolio?
Not allowed to.
Yeah, and there's no need to, correct?
Correct.
There's plenty of no load funds out there. If you're going to do it yourself, highly recommend that you stick with Vanguard as one of the top rated no load fund mutual funds out there.
There's lots of great companies. The key is you just buy the mutual fund directly from the mutual fund company, cut out the middleman, pay no commission.
Yeah. And by the way, you can control your fees. You can't control your investment return.
Correct.
Let's go to the next slide.
Okay. So when we look at mutual funds, they can become one of two ways. It could be active or passive management. Active management means the money's invested with a fund manager that's going to try and beat the returns in the market. So this could be some certain strategy that they use or other things. So the goal there is to outperform the markets every year. Passive management says, I don't really think people can on a consistent basis beat the market. So instead, I'm just going to try and get with whatever returns the market provides. Okay.
So would passive management equal index funds?
Correct. Indexing is the most common form of passive management. Yeah. So there's some pros and cons to both. With passive management, there's not a lot of trading, especially when you use those index funds. And so you can have incredibly low fees.
So the S&P 500 is a index fund.
Well, the S&P, there's indexes based on the S&P 500 index. And those fees could be as low as like 0.17, 0.25% versus an active fund, which may be closer to like 0.75 or 1%. So certainly lower fees, greater tax efficiency. The downside to them and the upside for active management is active management does provide a greater opportunity for above market returns. And with active management, the portfolio can adjust based on market conditions. So for example, if they think that there's going to be a downturn or a potential big loss in the market, they can make the portfolio more conservative to try and protect on that downside or protect the loss for the investors. The downside is if they're wrong, then you're limiting your upside. So the passive, you're not trying to do that. You just want to get whatever the market provides. But the downside means in years of big losses, your portfolio will be subject to potentially larger losses as a result, because there's no one trying to adjust or make the portfolio more conservative.
So one of the things is that when you're picking out a fee-only fiduciary advisor, you may want to ask, are they an active manager or do they believe in passive management or an index fund? In your practice, Paul, do you use a little bit of both, or are you more one way or the other?
Yeah, so in our portfolios, we're extremely cost sensitive. We know that cost is the single biggest predictor of someone's returns. So the lower fees that you pay, the better chance you have for your money growing. So we take a balanced approach, and we use a lot of passive managements, but we tie in active strategies on that, both internal and external, to provide a good mix.
Okay. And if you're on the active management side, don't pay attention to the name of the fund. There are probably over 18,000 mutual funds out there. And each one of these mutual funds have an active manager or someone in charge of making investment decisions.
Correct.
They change all the time. So you want to know, if you're going to go active management, you want to know the performance record of that manager.
Yep. And as they say, past performance is no guarantee for future results.
Exactly. Exactly. Trevor, how much time do we have left?
About 20 minutes, Pete.
Okay. Is there any questions out there?
No, but I would be happy to call for them. I did search through my emails and find the name of the person that you were looking to look up. If you want to do that, show them how to do broker check.
I think so. I think it's really important to do broker check. I would do it on I do it on Paul. I do it on every single person that comes on the program or that I meet with. I first go to broker check. It's so important.
Okay.
Yeah, and one thing I'd point out with broker check is it's going to get individuals that have those licenses that we talked about, the 7, the 66, anything like that. If they don't have those licenses, they're not going to show there.
Okay, so you, in regards to looking up on broker check, as you can see here, you put the name in this box, okay, and then you can also put the firm if you know, or the city, but so when you put the name in, and remember, this is all, we're not trying to bag on Troy here, because this is all public record. So if you are licensed to be a broker, you've signed up for everyone to look up your record, and that's just part of the thing. Hang on, let me erase my. There we go. So I think there's a lot of Troy Millers that.
LPL.
LPL. It's over on the as you're seeing the screen on the right-hand side.
Right. Let me just see if this comes up a little more.
It says LPL right on there.
Yeah, I see. Okay, so I put in both. I put his name and LPL. So it comes up like this. You'll see his name and where he's been around a long time. So the chances of having more disclosures are greater, but that has nothing really to do with it. And it'll come up here, and this has all the information about when he started, who he worked for over the course of years, exams he's passed, the states he's licensed to sell products in, his experience, and then over here you have a disclosures deal that talks about his disclosures. And often, now, Pete, this guy, it looks like he settled a lot of this with his clients, meaning they're not open-ended. A lot of times, these are not settled, and you can read about what's happened.
Well, it's kind of like J.P. Morgan with Bernie Madoff. J.P. Morgan paid a $2.6 billion fine, but denied any guilt or allegations that they committed fraud or did anything wrong. And so it's one of the problems of settling. Once you settle, you're not admitting that you did anything wrong.
Yeah. Now, Pete, also, I noticed right under his name, it says, and Paul, you can obviously chime in on this. It says he's a broker, and then he's also got an investment advisor. So he's duly registered. What does that tell us?
So, yeah, so the broker tells us that he sells commission-based products, that he's working with what's called a broker dealer. And then like my firm, we do managed money for clients. We are an IA, an investment advisor. So that means that he's selling both managed money as an investment advisor and commission-based products as a broker.
Okay. So, and can he charge fees on top of the commissions he earns?
So there's some limitations there. So for example, if they're doing managed money, it's typically not going to be Troy managing it. It's going to be a group that LPL has hired to manage the money. And if that's the case, they're not supposed to be using those A, B, or C fund shares. They're supposed to be using what are called institutional shares that have the lowest fees. LPL has actually gone knocked in the past for not doing that and using mutual funds that have higher fees that benefit them with what are called 12B1.
Okay.
LPL does not have a good reputation in the industry.
Okay, so Pete, can I demonstrate what happens when we look up someone like Paul here?
Sure.
What broker check does?
Sure.
So, Paul, we're putting you on the spot.
You're fine.
So I'm going to put Paul Horn in here. I'm not even going to put the name, and see if we can find him.
Number 2.
Number 2. There you are. Okay. So it has his experience, no disclosures. It has he used to be a broker, which he explained earlier in the presentation, but it says here that I assume previously registered means you're no longer registered.
Yeah, and so if you see the years of experience, my actual years of experience is about 15, but only 12 of them were as a broker.
Okay, and so so here is his thing. Now, I'm looking over here and it says the representative was previously registered as a broker and is currently registered as investment advisor. Visit IAP for information regarding the record. So what it's doing is it's redirecting me to the SEC site, which kind of holds your license as an investment advisor. Am I correct on that?
Correct.
Okay. So that is kind of a telltale way, I think, for a lot of people. I mean, it helps kind of distinguish whether they're fee only absolutely or whether they're duly registered. Is if where the broker check site will send you directly to the SEC site, and it looks similar, but you can tell it's different colors and all that. And this is what you'll have there, and you'll see. No, thank you. His Series 65 is there. He has a Series 7s from a previous, when he was a broker, but that was back in 2005. So you can get a lot of information about the current situation of the advisor.
And broker check is not the end all, the be all. I mean, there's a lot of criticism of broker check that they don't keep it up to date. They don't provide all of the information. But it's the best we have. And the entire industry operates on the philosophy, or the SEC operates on the philosophy philosophy of full disclosure. If I give you all the information there is to know about a particular individual or about an investment product, then you as a reasonably intelligent individual can make up your own mind. And that's kind of the philosophy behind broker check. It's also the philosophy behind a prospectus. So anytime you get a mutual fund, you get a prospectus, and that provides full disclosure.
Yeah, so the regulatory crutch of the whole financial services industry is full disclosure.
Yes, absolutely.
Okay.
There's a question that somebody had about TIAA.
Yeah.
TIAA used to be a not-for-profit insurance company. They're now for-profit, but it's still mostly insurance, although they now do have sell product. The individual who's asking the question saying that her particular advisor does not show up on broker check. It may be because they're not licensed. Maybe they just have an insurance license.
Right.
I don't know.
Yeah, that would be my assumption as well, that they're just insurance licensed and that's it.
Yeah.
I recommend anybody that hasn't, when you get your statements, you should have a name or of an advisor or broker on there to go ahead and put their name into broker check just to see what you find. And then you can always ask questions about what you find, and they may have a good answer for whatever, if you find anything that looks strange. But at least you can ask. I have a question, guys. Someone wants you to repeat. They kind of went a little quickly on the comments on institutional class, meaning the mutual funds versus the Class C, et cetera, all those.
Yeah. So on the mutual funds, every mutual fund has what's called a share class that determines how the fees are paid for that particular mutual fund. We talked about the A, the B, and the C shares. Those are the share classes that are sold directly from a broker, okay? Because those are the ones that have the commissions associated with them. Representatives that are investment advisors or fee only, they're going to use what are called institutional share classes. So that share class is not available to a retail investor. So like, anyone on this call wouldn't be able to go out and just buy what's called an institutional share class. They would be buying a no load share class. So firms like mine will use the institutional share class because it has the lowest fees available. So where the average fee may be, say, 1% for that large cap growth fund that we talked about, the fees for an institutional share class is going to be a lot lower.
Yeah, and they have many other classes. So they go by alphabet. And the only way you can really know what that alphabet means is by going to the prospectus. So they're a little hard to read, but usually they try to put the fees and the share class in one particular section, and it'd be worthwhile to check it out or Google and say institutional shares, PIMCO. Most of your PIMCO funds, for example, have multitude of types of asset shares.
Yeah, and actually because of individuals doing that, like Fidelity, which is one of the largest, mutual fund companies out there, they got sued on their own 401k by their employees because they weren't using the mutual funds with the lowest share class like they were supposed to on the 401k.
Own employees.
Own employees use the prospectus to find that information. So
another question, Paul, can a broker dealer sell you institutional shares?
Only if they're doing the managed money. They can't sell it to you as a commission-based product.
And talk a little bit about, because you were in the industry, wrap accounts. What are they and how are they sold?
Okay, so a wrap account is going to be what they call a managed money product. So the fees wrapped into the managed account. So Again, it's going to be a percentage of the assets under management. That fee could be as high as 2% at a lot of
I've seen them as
broker-dealers.
high as 3%, Paul.
Wow, the highest I've personally seen has been 2.25%.
Okay.
But that's 3% is amazing. But yeah, it's the same concept as like what a fiduciary does, but typically at a much higher price. So like if you look at the Morgan Stanley's, Merrill Lynch's, the wirehouses of the world, that fee is typically about 1.25% to about 1.5%, where a registered investment advisor is normally around 0.75 to about 1%.
You know, it's all about product sales. Remember the mortgage-backed securities? JP Morgan was fined $13 billion but nobody went to jail. Remember the 2008 crisis?
The Big Short?
The Big Short. $13 billion they were fined for selling fraudulent mortgage-backed securities. They never admitted that they sold it. Nobody pays $13 billion, without having some guilt. People think that when they purchase an annuity that they're guaranteed. Well, guess one of the companies that in 2008 that went under and that had to be bailed out. One of the largest insurance companies in the United States, AIG. There was in California, Baldwin United went broke as an insurance company. So the insurance companies, when they say guaranteed, is only as good as their financials are on their books.
Okay. What I wanted to do real quick before we run out of time was just because we didn't have a chance to do this at the beginning, but when you guys get your material or emails, there's a link that reminder emails for the webinars coming up. There's a link to our materials page, and this particular week is week 2, annuities and mutual fund. We will be putting on we have recorded this version and it will be edited and put on here right there. The presentation that you saw, so we had some questions earlier about where to find it. You can find it there, that Paul put it up, this right here. We have his Ask First form, which is if you want to get a hold of Paul for speak to him more, he has his information on there. And then there's a bunch of articles that Pete put up that talk more and go into more detail about some of the concepts and topics we spoke about today. So you can read those at your own time. Last week, if you missed last week, the video of the session is up and there, and also the handouts if you want those as well. So you kind of get the picture. We are starting to populate our weeks here, which is good. So next week we'll be getting more into financial planning. Pete, do you want to give a little overview of what's to come next week?
Yeah, next week we're going to talk about how to determine what you need, and you can do this on your own, or you can get an advisor to help you. But we're instead of most people think that when they go to a financial advisor, they're just going to them to determine what should I invest in, and that's the wrong way to go about it. And so we're going to go through what financial planning, how to begin that process. And we're going to go through net worth, how to budget, cash flow, taxes, how to actually begin that process of trying to figure out how to manage your own money.
Excellent.
And Paul, I think you did an absolutely super job. Thank you so much for doing this session, and really appreciate it. We don't pay anything to our presenters. They're doing this completely on a volunteer basis. And we love the fact that they can't sell any products and they just sell their services and their advice. So thank you, Paul.
Thank you for having me. It's been a real pleasure.
Okay.
Okay, great. Thank you all. And tomorrow we will be continuing with week 2 of our It's Your Estate if you're registered for that. So that will start promptly at 10 a.m. and look forward to seeing you then.
Thank you.
Thanks, Paul.
Thank you, Trevor.
All right.
Thank you, Paul.
Bye-bye.
Bye-bye.